Tonight, the number is staring back at us like it's alive. Silver is hovering so close to triple digits that you can almost hear the market holding its breath. And the weird part is, it doesn't feel like the finish line, it feels like the starting gun. And before you scroll away thinking, okay, cool, it's near a round number. Let me tell you what matters. Round numbers aren't magic, but human behavior is. And when crowds fixate on a price level, the moves on either side of that level can get violent. I'm recording this on Friday, January 23rd, 2026, and the exact time right now is 12 p.m. in my time zone. Drop a comment telling me what time you're watching this, because I want to see how global this moment really is. One quick thing, YouTube's own stats show a huge chunk of people watching these videos aren't subscribed. If you value this kind of no-fluff market talk, hit subscribe right now so you don't miss the next update. Also, check the description after this video because I've put bonus links there, including a premium WhatsApp channel link and a channel membership join link so you can choose how you want to stay plugged in. Now, let's talk about what's actually happening because the screen price is only the surface. Underneath it, there's a pressure system that's been building for years, and tonight you can feel it crackle. We're in that late hour window where headlines sleep, but money keeps moving. Futures don't care about bedtime. Asia wakes up, liquidity rotates, and the same metal can trade. Like two different assets depending on which side of the world is pressing buttons. That's why these quiet hours can be the loudest in terms of price discovery. So what's pushing silver up here? You're watching a collision. On one side, investors who want protection, momentum, and a trade that can run faster than gold. On the other side, real-world buyers who don't care about chart patterns because they need the metal for products that can't ship without it. And here's the trap most people fall into. They think silver is just little gold. That's lazy thinking. Silver is an industrial input, a monetary hedge, and a volatility grenade all at the same time. When those three identities align, the market doesn't move politely, it lurches. Over the last couple of years, industrial demand didn't just grow, it set records. Electronics and electrical applications kept hitting new highs, and solar didn't slow down the way the skeptics expected. In 2024 alone, total silver demand was about 1.16 billion ounces, and industrial demand pushed to record territory. Solar was a monster chunk of that, with roughly around 200 million ounces used by the PV sector in that year, depending on how you slice the reporting. That's not collector coin demand. That's factories, grids, and hardware that people expect to work every day. And the supply side, it hasn't been able to sprint to match it. Silver is mostly mined as a byproduct. That means you can't just wave a wand and say, mine 20% more silver next year. If the lead, zinc, copper, and gold mines don't expand, silver output doesn't magically surge. So when demand heats up, price has to do the balancing. That's the economic version of gravity. You can argue with it, but you can't repeal it. Now, here's where it gets spicy. Inventories. People love to talk about silver like it's everywhere, like it's stacked in skyscraper vaults waiting for some billionaire to dump it. But when you look at deliverable inventories in the major exchange system, the numbers get a lot less comforting. As of the latest official stock report this week, registered silver, the category that's actually available for delivery, sits around 116 million ounces. That sounds big until you compare it to annual demand. It's a slice, not a mountain. And more importantly, those inventories have been shrinking relative to the scale of modern industrial use. When a system is tight, the price doesn't need a disaster to move. It only needs a surprise. One large buyer choosing delivery instead of cash settlement. One manufacturer realizing their procurement plan is late. One logistics bottleneck. One regulatory change. One wave of retail panic. And then the market stops behaving like a market and starts behaving like a stampede. Let me break down a detail most people skip because this is where misunderstandings turn into bad decisions. On the big exchanges, you'll usually hear two inventory buckets, registered and eligible. Registered is metal that's been specifically assigned and ready to be delivered against a futures contract. Eligible is metal that meets the standards and sits inside approved warehouses, but it isn't automatically for sale. Eligible bars can be owned by private parties who have zero interest in handing them over at the posted price. So when someone flashes a giant total inventory number, the right follow-up is how much of that metal is actually willing to move at today's price. That's why the registered figure is the one that matters when people talk about a squeeze. It's the pool that can be drained, and it's the pool that can force a scramble if too many participants decide they want real bars, not a receipt. And if you think a drain can't happen quickly, remember this. A few dozen million ounces is not a science fiction number anymore. A single large industrial buyer, a couple of funds choosing delivery, or a wave of bars moving into private vaulting can shift that needle in days. The market is larger than it used to be, but the available buffer isn't growing at the same speed. Here's another underappreciated angle. Silver's industrial demand has changed shape. It's not just jewelry and old photography anymore. It's power electronics, electrical contacts, soldering, photovoltaics, medical applications, and the infrastructure that keeps modern life running. In 2024, total industrial demand was estimated around 680 million ounces, and solar alone was roughly 197.66 million ounces. Even if manufacturers keep trimming the silver per unit, the sheer scale of deployments can keep total consumption stubbornly high. Now layer in the macro backdrop that's been feeding this rally. Gold pressing up toward the $5,000 neighborhood has been a loud vote of no confidence in everything is fine. Silver's catching that same wave while adding its own industrial fuel. And when investors start thinking in terms of hard assets instead of paper promises, metals don't need a perfect narrative. They just need a credible role in the portfolio. And right now, silver is wearing 3 hats at once. But there's a second spark that can make this market even more explosive. Hedging stress. Producers and users hedge with futures. That's normal. The problem is what happens when volatility spikes. Exchanges can lift margin requirements, brokers can tighten risk limits, and suddenly a position that looked managed becomes a forced decision. People either post more collateral or they reduce exposure. That kind of forced de-risking can create brutal pullbacks, even inside a long-term bull trend. If you've ever watched silver drop hard with no obvious headline, that's one of the reasons. And then after the weak hands are shaken out, the physical market quietly reasserts itself again. So the cliffhanger isn't only, does silver touch $100? The bigger cliffhanger is what happens after the celebration. Do contracts keep rolling smoothly, or do more participants start insisting on metal instead of paper? Because if that behavior shifts even a little, the stress shows up everywhere. Spreads widen, premiums detach, and suddenly the screen price becomes a suggestion, not the price regular humans can actually pay. And here's the next test. When the market prints $100, do you hear cheers or do you hear silence as inventory disappears? Watch that very closely. Here's a question I want you to answer in the comments. Do you think the next silver squeeze starts with investors or with industry? Because in my view, the moment that matters is when industry stops shopping and starts hunting. Let me explain that in plain language. When investors buy silver, they can change their mind. They can rotate to tech stocks. They can chase crypto. They can sell because they're bored. But when a manufacturer needs silver, it's not a trade. It's a production requirement. And if they're short, even a small amount, they don't lose a little money. They risk losing a product cycle, a contract, and a quarter. That's why industrial demand creates urgency that charts can't model. Now, some people will say, okay, but the price is already high. Won't demand collapse? Yes, at the margins. Some uses will thrift, substitute, redesign. But a lot of silver demand is sticky because the metal's unique properties aren't easily replaced. Silver is the most conductive metal. That's not marketing, that's physics. You can swap it out in some places, but you often pay a performance penalty, a reliability penalty, or both. And in a world obsessed with efficiency, data centers, grids, EVs, automation, those penalties matter. Speaking of EVs, let's put numbers on it because most people never quantify. Traditional internal combustion vehicles can use roughly 15 to 28 G of silver in certain electrical components. EVs and hybrids tend to use more, often around 25 to 50 grams per vehicle, depending on design and the broader ecosystem. Charging infrastructure, power electronics, grid upgrades adds demand on top. Even if engineers keep reducing per unit, loadings, unit volumes can overwhelm thrift and the demand curve can still climb. Now add solar, add electronics, add medical, add defense, add the constant replacement cycle of modern devices. This is why silver can go from boring to unavailable faster than people expect. And now we get to the part that makes people uncomfortable, the paper market. When you see a price on a screen, you're often seeing the paper price, the price of contracts, not necessarily the price of immediate physical metal in your hand. Most of the time, that system works fine because most traders never ask for delivery. They roll, they close, they cash settle, they speculate. But when confidence changes, the rules of the game change with it. A tight physical market plus a leveraged paper market is like a crowded theater with one small exit. It's fine until it isn't. So who's short? That question triggers conspiracy brains. People want a villain with a name. They want a single monster under the bed. Here's my skeptical take. The short side is rarely one cartoon character. It's often a blend. Hedgers, market makers, banks, producers, funds, and yes, sometimes traders who push too far and get punished. Some shorts are rational risk management. Some shorts are directional bets. And historically, regulators have found that certain large institutions engaged in illegal tactics like spoofing in precious metals markets with enormous penalties paid in past cases. That doesn't mean every short today is criminal. It means the incentives are strong and the history matters. So, if you're waiting for one entity to be exposed before you take silver seriously, you're playing the wrong game. The real question is simpler. How much metal is there? And how urgently is it needed? Because the squeeze doesn't care about your storyline. It cares about inventory. Now, let's talk about the retail world for a second, because I'm hearing the same confusing reports from a lot of viewers. My local shop isn't paying spot, or premiums are weird, or they'll sell, but they won't buy much. That behavior isn't magic. It's risk management. When price is moving like this, dealers can get trapped between wholesale and retail. If they buy your metal today and the market whips down tomorrow, they can be sitting on inventory they can't replace at the same cost, or they can be stuck with product they can't move to refiners on favorable terms. Some dealers slow down buying, widen spreads, or temporarily get picky. It feels unfair, but it's a sign the system is strained. And here's the part the average person misses. When the wholesale bars become scarce, the market starts doing something ugly. It starts cannibalizing. Low-denomination retail products get melted, refined, recast, and shoved into the form that the industrial and exchange pipeline wants. 1-0's rounds, older circulated coinage, smaller bars, anything becomes feed. Stock when the system needs large bars for settlement and fabrication. In calm markets, that doesn't matter. In stressed markets, it matters a lot, because if the market is melting the small stuff, the stuff ordinary people can actually buy, then retail shelves don't just empty, they stay empty. And that's when you get the moment that burns into people's memory, the moment where price is less important than availability. Let me ask you another question for the comments. If silver hits $120, but you can't find any physical, does the chart price even matter? Now, I'm not here to tell you to panic buy. Panic is expensive. I'm here to tell you to understand the sequence of events so you don't become the person who says, I knew it was coming after it already came. Because look at history. In 1980, silver went parabolic and then collapsed. And a lot of people learned the hard way that leverage cuts both ways. That episode is remembered as Silver Thursday. And it's a reminder that markets can move from euphoria to gut punch in a heartbeat when rules change, margins change, and forced selling begins. And in 2011, silver ran hard again, then got slapped down, and the same lesson showed up in a different costume. Volatility doesn't ask your permission. So here's the counterpoint you need to hear. Even if you're bullish, just because silver is near $100 does not mean it must go straight up from here. It can spike, drop, chop, and psychologically torture both bulls and bears. That's what silver does. If you can't emotionally handle a 10% move, in a week you will make bad decisions in this market. But here's what's different now compared to those old spikes. Industrial demand today is not a side character, it's the main plot. Back in older cycles, the industrial base was smaller. Today we live inside electronics. We generate power with solar at unprecedented scale. We build grids for a world that needs more electricity, not less. We build data, centers that gulp power. And silver sits inside that infrastructure like a hidden nerve. When demand becomes structural, rallies don't depend only on hype. They can be reinforced by necessity. And when necessity meets a paper market that's used to people not asking for the real thing, that's where the story turns. Now, I want to zoom out and talk about gold for a second, because you can't understand silver without understanding how the market compares it to gold. The gold-silver ratio is basically a mood ring for investor preference. When the ratio falls, silver is outperforming. When it rises, gold is leading. In calm times, that ratio can drift like a lazy river. In chaotic times, it can move like a waterfall. And lately, silver has been acting like it wants the spotlight. That doesn't mean gold is weak. Gold has been tearing through records too, pushing toward the $5,000 zone. It means the market is paying up for both protection and utility. Now, some people will tell you silver must eventually become more valuable than gold. I'm going to be careful here. Could silver become extremely scarce relative to immediate demand? Yes. Could the ratio compress dramatically? Yes. Could silver overshoot in a mania? Absolutely. But more valuable than gold as a permanent state is a bigger claim, and it depends on what you mean by valuable. Gold is held in large bars and vaults because its value is concentrated. It doesn't corrode, and it's historically treated as a reserve asset. Silver is dispersed across billions of devices in tiny amounts, much of which is not economically recoverable. That dispersion can make silver scarce in the market even if the element exists in the world. So instead of arguing about slogans, focus on mechanics. Recoverable, supply, deliverable inventory, industrial urgency, and investor flows. Those mechanics can create a phase where silver behaves like it's the rarer monetary metal, at least in the tradable market. And that's when price targets that sound insane start to sound less insane. Let's talk targets because everyone wants numbers. Silver at $100 is a psychological milestone. It's not the end. It's the billboard on the highway that says you just crossed into a new territory. The next zone is where people who ignored silver for years suddenly pretend they discovered it yesterday. And when those latecomers arrive, they don't show up calmly. They show up emotionally. They chase, they buy because they're afraid to miss the move, and then they get punished by volatility and swear they'll never touch silver again right before the next surge. That's the silver cycle. So what would push silver from $100 toward much higher levels? A few triggers. One, continued weakness in the dollar or falling real yields. When cash yields don't keep up with inflation, money looks for shelter. Two, geopolitical risk that makes people distrust paper promises. Three, a visible inventory drawdown that becomes headline material, forcing industrial users to secure supply earlier and more aggressively. Four, a shift in investor portfolios where people stop treating metals as a fringe trade and start treating them as a core allocation. Five, a policy shock. Tariffs, export restrictions, sanctions, energy disruptions that make supply chains fragile. And here's the thing, you don't need all five. In a tight market, you might only need one. Now, I know some of you are thinking, okay, but I heard silver supply deficits are exaggerated. Fair point to question. So let's ground this. Recent global surveys and industry estimates have shown multiple consecutive years where demand exceeded supply, creating deficits measured in the hundreds of millions of ounces across several years combined. One widely cited survey put the 2024 market deficit at roughly around 149 million ounces. Whether you agree with every decimal point or not, the direction matters. Deficits don't have to be perfect to be powerful. They only have to be real enough to drain stocks over time. And that's what persistent deficits do. They eat the buffer. Markets can ignore a deficit for a while if they have stockpiles. But once the buffer thins, every new shock becomes bigger. Now, let me bring this down to street level again because I don't want this to be abstract. If you're sitting there without any physical silver and you're thinking, I'll wait for a pullback, you might get one. Silver can and will pull back. But the question is, will you be able to buy the kind of physical you want when the pullback happens? In normal markets, a dip is a shopping day. In stressed markets, a dip is when sellers vanish. That's the nightmare scenario for late buyers. Price drops, but product doesn't appear. Or product appears with premiums that make the dip meaningless. So your plan should be about availability and timing, not about perfect price prediction. And this is where I have to remind you, if you've already been successful in metals, I want you to share your success story in the comments. Not to flex, just to keep other people motivated. A lot of viewers are watching this quietly, wondering if they're too late or too early. Your story can help someone make a calmer decision. Now, quick mid-video reset because we're getting deep. If you want to learn silver-related success stories, real examples of how people positioned themselves and benefited, the link is in the description. Subscribe there too and see how people made money because sometimes the best education is watching how others navigated the chaos. Back to the chart. What you're seeing right now is the market testing the psychology of $100. It's like a heavyweight leaning into the ropes before a punch. You get taps, pulls, feints, fake-outs. The market wants to see who flinches. And let me tell you what the market loves more than anything. It loves to embarrass as many people as possible. If everyone is screaming, we hit $100 tonight, the market has a sick sense of humor. It might spike to $100.70, then dump to $94 just to shake weak hands, then rip again to $16 when the most people are out. That's not a prediction. That's a warning about behavior because silver is not a straight line asset. It's a test. Now, let's talk about the banking system narrative without turning it into a comic book. Yes, precious metals markets have a history of questionable behavior. Yes, some large institutions have been punished for illegal tactics in the past. Yes, paper leverage can suppress or distort price in certain windows. But here's the counterweight. The bigger the distortion, the bigger the snap when physical tightness asserts itself. It's like pushing a beach ball underwater. You can do it for a while, but eventually your arms get tired or the water level changes and the ball explodes upward. Silver's physical market is the water level. So when you hear people say they'll never let silver run, remember they don't control geology, fabrication, demand, and inventory math. They can influence trading behavior, they can influence sentiment, and they can absolutely create traps. But if the physical market becomes critically tight, price has to respond. Now, let's address the weirdest and most important part of this story. Silver is cheap in one sense, even at $100. I know that sounds crazy, so let me clarify. In nominal terms, $100 is huge. But compared to what silver was in inflation-adjusted 1980 terms, it's not there yet. Depending on how you calculate inflation, the 1980 peak would be well over $200 in today's dollars. So if someone says silver at $100 is already the biggest bubble ever, you can respond, we've seen higher in real purchasing power terms decades ago. That doesn't guarantee it goes to $200. It just tells you $100 is not automatically the top because the number feels big. Now, here's where this gets personal. A lot of people will watch this and do nothing. They'll wait for certainty. They'll wait for a clean headline. They'll wait for a perfect entry. And then when silver is much higher, they'll say, I wish I bought under $100. That regret is predictable. It happens in every asset cycle. The only thing that changes is the asset and the excuses. So what do? You build a plan that matches your reality. If you're a trader, you respect volatility and risk. If you're an investor, you focus on long-term supply and demand. If you're a person who just wants a hedge, you aim for sensible accumulation, and you avoid the emotional extremes. Because the worst thing you can do is enter a volatile market with no plan and then let the market write your plan for you. Now, I need to talk about the paper versus physical choice in a way that doesn't turn into a sermon. Paper vehicles can be useful, they can be liquid, they can be easy, they can be tradable, but paper is still a promise. Physical is a possession. In calm markets, the difference feels small. In stressed markets, the difference feels like a canyon. And if you're going to hold physical, you need to think about form factor. Not all physical is equal in liquidity or premiums. Smaller units can be easier to use and sell, but premiums can be brutal. Larger bars can be closer to spot, but they're not as flexible. Older coinage has its own niche, but availability can tighten fast. That's why I never tell anyone there's only one right way. There are trade-offs. What I will tell you is this. If you do own physical, make sure you actually control it. The point of physical is that you're not depending on someone else's balance sheet. Now, let's talk about what happens after $100, because this is the cliffhanger that matters. The first time silver breaks a round number, the headlines are excited. The second time, the headlines are nervous. The third time, the headlines are angry. And at some point, the narrative shifts from look at this interesting rally to why is this happening and what is it breaking? That narrative shift is where the real money moves. Because once the public starts asking why, institutions have to answer. And those answers often lead to more buying, not less. So here's the scenario you need to be ready for. Silver pops above $100, pulls back, and everyone calls it a fake out. Then it grinds. Then it surges again, and suddenly $100 becomes the floor everyone wished they bought. That's how markets trap the maximum number of people. Now, if you're thinking about extreme targets, $500, $1,000, even higher, I'm not going to laugh at you, and I'm not going to promise you anything. Extreme targets are possible in one specific kind of environment. A monetary confidence crisis plus physical scarcity plus a rush into hard assets. In that environment, price becomes less about value and more about clearing. The market has to find a level where enough sellers appear or where enough demand is destroyed to restore balance. If nobody wants to sell, an industry must buy. The clearing price can look absurd. But here's the honest part. Timing those extremes is impossible with precision. The path is not smooth, and along the way there will be pullbacks that feel like the end of the world. So if you're listening to anyone who tells you silver will be exactly $1,000 by Tuesday, you should back away slowly. What I can do is map the forces. Industrial demand rising and sticky, supply constrained. And byproduct driven. Inventories thin relative to modern consumption. Macro backdrop, uncertainty, rate cut expectations in the future, and a global preference shift toward hard assets, market structure, leverage paper that can unwind violently. Put those together and you get a metal that can surprise people in both directions. Now, let's talk about what nobody wants to talk about. What could cool this off? Because if you're serious, you consider both sides. 1, sustained high prices could accelerate thrifting and substitution, especially in solar and electronics. 2, recycling could increase as people cash in old scrap at higher prices, adding secondary supply. 3, if real interest rates rise sharply and stay high, speculative money can exit metals. 4, if a major recession crushes industrial output, industrial demand can soften, at least temporarily. 5, if governments intervene with emergency measures, export rules, stockpile releases, regulatory changes, markets can get hit with sudden shocks. So don't confuse a bullish setup with a guaranteed straight line, but also don't ignore the bigger reality. Even with those cooling factors, the long-term electrification trend is not going away. Power grids, data centers, EVs, renewables, those are multi-year forces, and silver is woven into them. Now, I want to give you a practical perspective on the short squeeze talk. A squeeze isn't just shorts get wrecked. A squeeze is a mismatch between promised supply and demanded delivery. If too many people insist on the real thing at the same time, it forces the system to bid up. That's why delivery metrics and inventory reports matter more than social media slogans. And that's why you should watch not just the price, but the spread behavior, lease rates, and physical premiums. When those start acting strange, it's often the market whispering before it screams. Now, since you're still here, I'm going to give you a small challenge. If you've been winning in this market, whether it's silver, gold, miners, or even just discipline saving during a chaotic time, share your success story in the comments. Keep it short, keep it real, and help someone else stay steady. Motivation is a resource too. All right, let's talk about the membership. Slide quickly because I get asked about it nonstop. We do offer members-only videos, and they're not just the same content behind a Peibu wall. A separate team helps produce those with deeper research, more charts, and more detail. Those videos are only for premium members, and if you want that extra layer, the join link is in the description. And again, don't forget the description also has that premium WhatsApp channel link so you can get updates and extra notes without waiting for the next upload. Now, back to the moment we're living in. Silver around $100 is a signal flare. It tells you the market is repricing risk, repricing scarcity, and repricing trust. And here's the part most people miss. When silver moves, it doesn't just affect silver, it affects everything that depends on silver. Electronics costs, solar input costs, manufacturing timelines, even sentiment around the broader commodity complex. Silver is small enough to be ignored until it isn't. And when it stops being ignored, it can drag attention into other hard assets too. So what do I think happens next? I think we get the classic silver dance. Break, recoil, break again. I think the market will try to shake out the maximum number of people. I think the headlines will swing from celebration to fear to ridicule. And I think the underlying industrial story keeps grinding forward while the paper market tries to keep up. And the biggest cliffhanger is this. When the next wave of buyers shows up, will there be enough physical available at any reasonable premium? Because if the answer is no, the screen price will become a suggestion, not a guarantee. So here's what I want from you. First, comment what time you're watching. Seriously, I want to see the spread. Second, answer my question. Do you think the next squeeze is triggered by investors or industry? Third, if you're not subscribed, fix that. If you watch this channel and you're not subscribed, you're basically telling the algorithm to bury the work. And finally, keep your head. Silver rewards patience, but it punishes emotion. I'll keep tracking this with you. And whether we tag $100 tonight, tomorrow, or after the next shakeout, the bigger story is already in motion. Take care of yourself, take care of your people, and I'll see you in the next one. And just as a final note, nothing in this video is financial advice. This is market commentary for educational purposes, meant to help you think clearly and do your own research before making any decisions.